Okay, let's consider the USD yen here. So the candle will close in a few seconds. This will be a valid entry setup. When we have a valid entry setup, we have to define where the entry should be. We have a tool to handle our trade, which is called the MTM, the Max Trade Monitor. I will not illustrate it here today, so I will simply draw an horizontal line where I will make my entry somewhere in this area. So you can see that the price has hit that level, and so normally I should have pushed on the button to open the trade, and the stop loss is placed here. Let me see what is our entry setup. The stop loss should be placed minimum in this area. Yes, minimum in this area, giving us, so it depends on the level of the max we are using, giving us, considering a spread of let's say 2.5 pips here, a stop loss of approximately, let's say 15. Let's widen it a little bit just to make a round stop loss. I hate MetaTrader. Sometimes we have to fight, mainly when we use it in combination with GoToWebinar. So let's say 14.5 plus 2.5, this means 17 pips. And so I will note on the chart ESL 17 pips. Now, an ESL always means, in our jargon, emergency stop loss. An emergency stop loss is a stop loss which has an important role. Its role is to protect our trading account in the case we lose the contact with our broker server. We may have an internet connection interruption. We may have the platform crashing. So we may have a lot of reasons why sometimes at some moment we can be blind for our trades. And sometimes we can even not contact our broker. And so this is always a hard stop loss, protecting the account in the case the price reverses very quickly and touches our stop loss. Of course, during the trade, if the price moves adequately, we will adjust that stop loss in order to reduce the global risk we have on the trade. The size of the trade we open when we have a valid entry setup depends on that stop loss size, but depends also on the percentage of the trading account we accept to risk on the trade. It may be 2%, 1%, 0.5%, whatever the risk level you accept to trade, because this is specific to each trader, to each trader's aversion, risk aversion. Of course, we teach in our courses that we must always consider a wise risk per trade. Personally, I even consider that a 2% risk is too large. Personally, I like to use a risk between 0.5% and 1%. In the today context, 0.5% seems for me perfectly adequate. Let's see some other opportunity. You see the euro US dollar has begun to go downward rather nicely, not big movement, but rather nicely. And let's see other possibilities here. Not a good setup situation here. We have rather longish bar. We don't like long bars in the max when we consider entry setups, because very often a long bar is followed with a retracement. However, when we catch a long bar in a trade, this is always a good situation, because a long bar is then an opportunity to bank some profits. If I have the opportunity to show you, I will do that. So this means that when we are in a trade and we catch such a long bar without any reason, of course, because if it is due to a news release, we are not in the trade. But if we catch a long bar with no reason, we define where to make an exit, and if the price retraces to that level, we close a portion of the trade. Whenever we open a trade, we consider it is made of 2 units, and so when we have to make an exit, we close 1 unit, keeping 1 open unit. For the case the price resumes the movement. So we close 1 unit, we call that a minor exit or a momentum exit. And so with a long bar, we have almost always the certainty to bank some good profit. And the level of the retracement is up to the trader. We advise to take, for example, 1/4 or 1/3 or even 1/2 of the size of the long bar. So this is a technique you can use in any of your trading systems. So for the pair which has begun to move downside, we will wait for an entry opportunity. So I will wait for a pullback, for example, in the euro US dollar, in the pound US dollar, in the pound yen, before considering any trade opportunity. We have another one having appeared here, the CAD yen, to go long too, but the price is not following through to hit our entry level. Let me draw an horizontal line where I would consider to make an entry if this is the case. And so my entry would be somewhere in this area. Somewhere in this area with a stop loss size in this area here. But the price obviously doesn't follow through. And so when the price doesn't follow through, so we don't take the trade. We have another one here on the pound Aussie to go short here. So let me draw the vertical line here with a potential entry setup somewhere in this area. But we are facing at a few pips lower this level. And so I prefer to see an entry setup below that level before considering opening the trade. So we have to wait. So I will set my entry level. So here we have too many in-between levels to consider a useful entry. With the max, we have a winning rate of approximately 75%, and 15% of losing trades, 10% of break-even trades approximately. Of course, that winning rate is not constant over time. It's varying over time. With good market conditions, the winning rate is larger. It may be 80%. With bad market conditions, the winning rate can drop to, for example, 70, 65, even 60%, and in rare occasions also to 55%, but never a big drop in the success rate, which comes back very quickly. The success rate has a tendency to is larger also with higher time frames. And so with the 4-hour, the 8-hour, the 12-hour, the daily time frames, the success rate can climb up to 90%. But we don't have so many opportunities to make scalings in the corresponding position. Roger, no, I'm not considering here pure ETF. I have added the ETF, and I'm considering, yes, indeed, most of the setups here as ETF setups. Okay. But I do not neglect the other possible setups. Now, when we have the uppermost level of the max is called the max sum ETF. So it uses the combination of these ETF lines with something else giving us many more details in the price action. In such a case, we have many more opportunities when we are trading a small time frame, like the 5 minute. During the European session, when I trade, I get between 4 and 10 trades opportunities per day, per pair, which is a lot. But the consequence is also the winning rate drops. And sometimes, just to give you an example, when I have 10 trades during the day, some days I may have 100 winning trades, and some days I may have only 3 winning trades. So the winning rate may drop considerably with the MaxSum ETF. But this is not a problem, because the reward to risk ratio with the MaxSum ETF in the case of a winning trade is way larger. And so with a losing trade, the loss is always small, like with all the other level of the max. But when we have a winning trade with the MaxSum ETF, very often the reward to risk ratio is extremely large. And so this compensates when the winning rate drops below the 50% level. So will we see here the pound resuming the down movement after that pullback? Let's see that. You see that my US dollar yen is not well engaged for the moment, but no panic. I have said, if you remember, that I had a small bias on the US dollar, which was a negative bias, but not really relevant. But these are the small risk to a long trade, of course. So I would not be surprised at all to see that trade being closed with a loss, which I never care, because it's never a trade which makes a good trading system. By the way, in this case, on this candle, if we strictly follow the rules of the max, this red candle is what we call an exit setup bar. And when we have an exit setup bar, we have rules to define where to make an exit. The exit would be around this area. You can see that the price has not followed through, so no exit. This means that whatever the exit technique we use, once we have a setup, we want to see the price hitting some levels in order to activate the execution of the exit. So our entries and our exits are always made in 2 steps. We want, first of all, to identify an entry or an exit setup, and then we define a level where we open the trade or where we close 1 unit. And if the price follow through and hit the level, so we close 1 unit, or we have the possibility, when we have more experience, to use what I call a discretionary situation, which in this case, and this is what I do myself, is because I'm using a very small risk per trade, 0.5%, for example. If I make a full loss on the initial stop loss, it's not a big loss. It's a small loss. 0.5% is not a big loss. Okay, so I accept to close my 2 trades at worst on my emergency stop loss, and I consider to close 1 unit only if the price has moved in my favor and gives me enough profits when I will have to close 1 unit. And the reason for that is the following. I have always been a very risk-averse trader, but very risk-averse trader. And in the past, whenever I had an exit technique triggering, I made my exit, my MX, minor or momentum exit. After having made several thousand trades since 2008, last year, I have made a deep statistical analysis of my trades. And then I have realized that with my trading style, should have I made my MX with the discretionary rules I have explained, my global profits over all that period from 2008 to 2016 would have been way larger. And so despite the fact that I am a very risk averse trader, then now I adopt that rule. But also the main reason is because my risk per trade is very small. For our students, I strictly advise them, I firmly advise them to make an exit when the exit technique triggers. Okay, let's see here if the pound kiwi gives us a valid entry setup, because we have a candle here. No, it is not a valid entry setup. So we have to wait perhaps the next candle, but then we will be too close to the home base. So we have to wait five more minutes. Not a retracement enough in the euro US dollar, not a retracement enough in the, no retracement at all in the pound US dollar, nothing in the pound yen for the moment. And in the CAD yen, so the entry setup to go long is no longer valid. Perhaps another one will appear here. And nothing significant in the pound Aussie and in the pound CAD. And so trading is also a matter of patience. You see here, while the price is going against my trade, I never panic for several reasons. First of all, I know that our setups are good setups. And second reason, my risk is very small. And so I apply a very strict rule. And usually we write on the chart, you see here, patience and disciplines. I have that label on any of my chart. And this helps me at any moment to remember that I need to be patient and I need to be disciplined. So I don't deviate from my max rules. And you see here, we have a possibility for the price. I'm not sure it would be the case, of course, but we have the possibility for the price to come back. And I will consider to take a first MX if the price moves upward, make some pullback, triggering one exit technique, and the minimum level I would like to see to make an MX will be around this area. Let me draw a horizontal line to pinpoint that area. So around this level, plus the spread, so 11 pips, so it will be somewhere, just at the top of the screen. So somewhere in this area here, or at a better level. And this is typically what we get in the market when we have no reasons with the news for the market to move. So the price is moving slowly. The price does not make big movements. And so traders who try to force the trade most of the time will be frustrated. And so these days, when I see such kind of behavior, I prefer to step aside and not trade at all. When we have a day when we expect riskier trade, and because we focused mainly on the risk aspect of a trade, we simply don't trade. For the US dollar yen, you can see here, before the Frankfurt Open, during the Asian session, the price was in a very choppy mode, but in a very tight range. You see only 15 pips approximately, but in a very choppy mode. And now the price seems to be outside the choppy mode. And it is not a surprise to see that retracement here right on our home base, but also right on this resistance level here. You see in this area, this is a zone, an area with that top here, and the price came back right on this level. And so this had some confirmation of the validity of this setup, but I consider this trade as a risky trade for the reason I have just explained. Okay, something may prepare for the pound kiwi, but we have to wait for the present bar to close. And we have something reversing here on the CAD yen, which may present a good opportunity. If the price succeeds to give a short setup below our home base, it will be a good opportunity. But this will not be good for the US dollar yen, because this will mean that the CAD will strengthen, will weaken, or the yen will strengthen. And if it is the yen strengthening, this will be bad for the USD yen. But it may be most probably the CAD weakening, because we are also going to see the CAD yen, the pound CAD going upward. And so we may have a setup, a short one in the CAD yen, a long one in the pound CAD. But we have to wait for the candle to close. We always wait for the candle to close before assessing a valid setup. Something may prepare also for the pound Aussie to the upside now. Again, after that pullback, the price seems to come back, and above that level would be ideal. So let's erase here this ESL level. We have a tool which is called the Max Trade Monitor. Here you see it is an EA, which helps us to handle the execution of our trade for our entries, our scale-ins, our MX, our XXX, which represent a global close. And whenever we have several open units, depending on the number of scale-ins, of course, we have one unique stop loss. We can adjust with the mouse like an horizontal line. And so with that tool, we have a one-click button tool to handle our trade, and it's really easy to handle the trade. We have just to place also the stop loss in a manual way, and the MTM calculates automatically, provided we input in terms of parameters the percentage of the trading account we accept as a risk for the trade. It calculates automatically the trade size using our position sizing concept. And so the setup which was preparing here in the pound Aussie is disappearing, also in the CAD yen. So we have to wait. We may have a potential setup in the pound kiwi, but we are too close to our home base, so not a good situation, because the price can always bounce off from the home base channel. So look here, this is exactly what is happening on the pound yen. But I like the downward bias on the pound kiwi and on the pound pairs in general. So maybe here in the pound US dollar, we will see. So a few seconds. But if the candle stays as they are now, we will have no entry setup at all. and indeed not a good setup on the pound Kiwi. We have an entry setup bar, but the conditions are not appropriate because we are too close from our home base. The price is reversing, seems to reverse to make probably another pullback in the pound Kiwi, not a significant pullback in the euro US dollar. We still have to wait on the pound US dollar. Nothing on the pound Aussie, nothing yet on the pound CAD, nothing on the CAD yen.
Hi, Eusebio.
Hi, Chris. Yes, please.
Hi. I'm just to let everybody know, for Maxes, there is a there is our chat room is running. I think I've been through all the Max people and told you in your chat area in GoToWebinar where the password and the link for the chat room is. If you don't have it, just ask. To everybody else, I'm just about to put up the Newswatch page so that you can check out our Newswatch. There's no charge for it. And if you want to subscribe to it, then when we update it each week, I'll send you out an email to say, hey, come and get the latest news and the top 14 or so pairs that are moving the best. And also, I'm going to put in there also a link to the max price levels. So it's a free group that you can join up to. Eusebio updates it with a couple of 3 charts every week so that you can get some idea on what the levels are like. And if you like them, then you can upgrade to the subscription levels, and the information is in the group itself. So I'll be putting those 2 links in shortly. And excuse me, just a reminder, at the end of this session, we'll be giving away 1 primer course. So hang around and you could be in for a life-changing experience. So thanks, Eusebio. I'm done.
You're welcome, Chris. So this candle will close in 2 minutes, and we may perhaps see a short setup on the CAD yen, a long setup on the pound CAD. Now, a very important feature our max trade monitor gives us is always 2 informations. The first information, and we always focus, is the risk we have on the trade, which is based on our stop loss placement. And whenever we adjust the stop loss, the max trade monitor adjusts the remaining risk. And another feature, it gives also the profits we could make should we close the trade at the present price, or the result, because of course if the price goes against the trade, the result will be a negative number. And so this is really a very important feature of that tool to help us handle the trade. And this is especially the case when we are in appropriate conditions to make scale-ins in the trade. So to add to our position, today it's out of question to make scale-ins, at least for the moment. But I don't see any opportunity for today for the market to move. And so riskier situation, and so when we are in riskier situations, so we have to better control the risk. One way to control the risk is, of course, not making scale-ins in our trade. We are seeing the pound yen progressively continuing to go a bit higher. Not a lot of movement for the moment. It's only 5 pips, so it's nothing. It's nothing, but it may be enough. It may be enough, considering the slow dynamic we are seeing in the market, to begin to tighten the stop loss. And we have specific rules to tighten the stop loss, to adjust the stop loss. For example, I will tighten my stop loss in this area now, in this area, and you can see that the risk is reduced importantly. Instead of having a stop loss size of 17 pips, now we have a stop loss of, let's say, 8 pips plus the spread 2.5, so let's say 11 pips. 11 pips, this means that we have reduced by 1/3 the size of the risk, okay? You see also that this would provide the worst case scenario for the trade, but the best case scenario among the worst case scenario, if I can use that expression, is here. This is what we call our movement invalidation area. This is the last place, it is our last resort exit. And so this means that if we have to make an exit, let's say in the middle of this area, I don't know where exactly the exit will be because it depends what the price is doing. But you can see that the practical risk, in fact, is only here around, let's say 3.5 pips plus the 6 pips. 6 pips. So this means only 1/3 of our initial stop loss. Okay. This means also that if I have to close my trade, my 2 units on this level, my loss will be only minus 0.33 R. R being my financial risk, for example, 1%, 2%, 0.5%. Okay. And so in any way, I'm the guarantee now that my loss will be a very small loss. Of course, if I have an internet connection problem and the price reverses quickly, I will make my loss here. Okay. But as long as the price will move in my favor, I will be able to adjust my stop loss, and this area for the movement invalidation will go upward, reducing the risk. So we consider always 2 levels of risk: the worst case scenario and what happens in the case we are forced to close the trade in what we call the movement invalidation area. And we adjust regularly our stop loss. Personally, I like to adjust my stop loss every bar or every 2 bars. We have some of our max traders who adjust the stop loss after 2 bars, 3 bars, 5 bars. It's up to each one to consider how many bars to use. I like to reduce my risk whenever I can. I like to reduce my risk, even if it is by 1 or 2 pips. I like to do that because 1 or 2 pips can make the difference. Let me check what is happening on the other pair. So nothing here, nothing here to close to the home base. Maybe here short setup in the pound US dollar. Too early in the pound Aussie. Here in the CAD yen, yeah, we have some possibility in the CAD yen here. Let me widen the chart here. Let me check. You see, this is the problem when we explain, in fact, things in the room. This was a valid entry setup to go along with the CAD yen, with an entry approximately in this level. That mark the chart. In real time, it would not be still too late to open the trade, and a stop loss around that area here, giving a stop loss size of how many pips we have. Let's say 3.5 pips. So here we have, let's say 14.5 and 3.5, 18 pips. So ESL 18 pips. Pips. And now we are seeing other potential setup, but 2 longish bar here on the pound Aussie. pound card is possible. Personally, when I have opened 2 trades, I stick to these 2 trades only. I never trade more than 2 trades simultaneously. But we have, of course, an entry set up here on the too long bar on the euro US dollar, too long bar on the pound US dollar. But the market seems to move now. Too long bar on the pound Aussie, and a potential entry setup on the pound card to go short. So here. So some action in the market, but these action may be short-lived, of course. For those of you who were, we had 2 workshops, one yesterday and one last week for our Max members, and I have shown situations where I have considered on the 2 days 4 trades. One has been a losing trade, and during the day, at the end of the workshop, the other 3 trades were still opened, and all these trades have been closed as winning trades. So right online with the winning rate, the normal winning rate.
Eusebio, while we're waiting, maybe it's a good time to ask some questions.
Okay. Yes, sure. Yeah, because okay. I will not consider other opportunities. I have my 2 trades here, and so I will stick to them.
Okay, so try not to get too diverted. First question is, are the indicators used by the Max general ones, or I can use them on any trading platform?
Most of the indicators we are using are standard indicators. There are 1 or 2 exceptions. For example, the ETF indicators are custom indicators. There is a small tweak with the Bollinger Bands, but all the other are standard indicators. Okay. Or indicators we can find freely on internet.
And I'll just add to that, if anybody wants, we do our training on MetaTrader because it's free, ubiquitous, there's no charge for the data feed, and it's got quite a few pairs, and if you use CFDs, you've got pseudo futures and stuff like that on it. If you want to use NinjaTrader or TradeStation, then some of our members have supplied us with indicators, Max indicators, which will work on those at no charge. They're available from our forum. And if you want to port the indicators to a particular platform that you like, I've got no problems giving you the source code for our indicators. They're reasonably simple. It shouldn't cost that much if you need to pay to have them actually converted. So there's not really all that much in the way of proprietary stuff in the Max itself, but we do have some cool ideas. Okay, thanks.
You're welcome, Chris.
I'll just dig up some more questions here. I think you've been kind of explaining this question has been going through, but I'll bring it up just to be formal. For the entry, how do you judge the probability price will move in your favored direction? Is it the moving averages that you look at, or do you look at data, deeper data like level 2 and order flow?
No, with the Forex, we don't have the level 2. Or when we have some brokers propose some kind of level 2, but based on their own, based on the trade of their customers. So it's not a real level 2. We need to go on other markets to have a real level 2. So the probability of our setups are simply statistical probabilities, and we increase somewhat these statistics when we are also online with a global context. When we have a clear global context, we trade only online with that global context. As I've explained today, I have not seen today a clear global context giving us clear bias for some currencies. So let me repeat. Let's suppose today we have an upward bias for the US dollar, a downward bias for the pound. Then for a pair like the US dollar yen, I would consider only long trade and only short trade with a pair like the pound US dollar, or any pair starting with the pound, or the pound as the base currency. And if we have a setup in the opposite direction, I will not consider taking that entry setup. And this reinforces the probability of success of our setup. Brett, the max works nicely also with the futures market. We have several of our max values trading in the futures market. For example, with NinjaTrader or TradeStation, we provide also the indicators and the templates for these two platforms. In the past, we have had kind members having translated our MetaTrader indicators into NinjaTrader and TradeStation, so we provide them, and the max work perfectly nicely with the futures market, with the future market. And for example, we have traders trading exclusively some commodities like crude oil, like gold, or even some indices, the DAX, for example, the YM, the Dow Jones Industrial Average futures contract, and so on. And so, in fact, you can trade any financial market with big volumes, in fact. The winning rate, Brett, is the following information. If you consider a sample of 100 trades, okay, then you will see 75% on average of winning trades, and 15% of losing trades, and 10% of break-even trades. Now, of course, if you are serious trading, you know that the winning rate is not a measure which is enough to give an idea of the quality of a trading system. The winning rate is not enough, even if many traders feel more comfortable with a high winning rate. But I can show you trading system having even a 95% winning rate, but still being losing systems. In fact, what is much more important is the expectancy. And the expectancy is simply, if we take that sample of 100 trades, the average result per trade. So you take the global result of your 100 trade, you have possibly to weight them depending on the risk you have taken per trade and the size you have taken per trade. And so you have a weighted average result of each trade. This is the expectancy. Another way to calculate the expectancy is you use the formula of the expectancy. So it's the probability of a winning trade times the average profit of a winning trade minus the probability of a losing trade times the average size of a loss. So this is the expectancy, which is the average result per trade. And to have a profitable system, you need to have a positive expectancy. Now, of course, there is another difficulty with the expectancy. If you take two systems, system A and system B, and having different expectancy, positive expectancy, which is the best system? It's not necessarily the system having the highest expectancy, because another parameter to take into account is the frequency of the trades. It may happen that the system with the highest expectancy has a lower trade frequency, and the system with the lower expectancy has a higher expectancy frequency. And so what is important is the product expectancy times the frequency of the trade over a certain period of time. This will give you a better opinion about the quality of the system and what you can expect with that system. So let me check what is happening here on the pound, on the US dollar yen. So you see the price has failed to reach my minimum level for profit. It is retracing now, but no problem. And as you can see here, my movement invalidation area is climbing. It is almost at the level of my entry, so I am almost break even with that trade. And in the meantime, I can even tighten a little bit my stop loss here in the case, the worst case scenario, should I become blind for the trade. Okay, 7 pips, so less than half of my initial risk. A very frequent question is, why do not adjust the stop loss in this area? First of all, I don't know exactly where the price will invalidate the movement, but it will be in this area. And secondly, what may happen is a situation like this. You see all these fast spikes to the downside. Look this one. Okay, look this one here. And so sometimes we may have in this area a fast spike touching our exit level, and then the price comes back very quickly. If this is the case, we don't need to close the trade. As soon as the price has moved away the area where we should expect to make an exit, we avoid to make that exit and we stay in the trade. Should we place the stop loss in this area, if the price hits the stop loss, then we are stopped out. And this is why I always prefer to execute my exit manually, just to profit from these dynamics in the price, in the case the price is moving very fast while making these downward, because we are in an up movement. Okay, but I always keep an eye in this area. And you can see that in the pound yen, for example, for the moment the price is doing nothing. But it's just a matter of patience. So we have a good potential movement between our home base, which has acted as a support level, until this level here, which has acted as a supply level. Oh, sorry. What have I made? I have closed the pair. Okay, that way. Yeah, you are right, Dilip. We have also, but this is a more refined analysis of the performance of a trading system. What is the maximum drawdown and what is the recovery rate of that drawdown? This is important too. But these are not easy questions to ask, to answer. Why? There are two ways to consider the drawdown problems. What is a drawdown? When the trader is facing a losing streaks, this means a succession of losing trades, so several trades in a row, the account will suffer a drawdown. The account will go downward. And so at some point, the traders will have to recover that drawdown. And the profit to recover will increase, in fact, exponentially, depending on the depth of the drawdown. Deeper is the drawdown, way more important is the profit to recover in an exponential way. For example, if your drawdown is 10%, you need to make a profit around 11% to recover. If your drawdown is 25%, you need to make a profit of 33% just to recover. So the recovering is much more important. If your drawdown is 50%, you need to make 100% profit to recover. And so your drawdown may increase linearly, but your profit to recover will increase exponentially. And so there are several techniques to control such kind of drawdown. First technique is, of course, to use a small risk per trade, in such a way that if you face a losing streak, the impact of that losing streak will be small. But at the same time, your account, when you will be in a favorable period, will not grow as fast. So it's always a question to find a good balance. Another way to control the drawdown is, and this is something which is used by many traders, is to consider a maximum losing trade per day. And some traders will consider that after 3 losing trade during the day, they stop trading. This is for me in contradiction with one of our principles, which is persistence. Why? When we know the winning rate of a trading system, we may have a good idea of the losing streaks we can face. For example, with a 70% winning rate or an 80% winning rate, like with the max, we can face losing streaks of 4 to 10 losing trade in a row. 10 losing trade in a row. Myself, my record is 6 losing trade in a row for the moment, but I know for sure that one day I will have a losing streaks made of 7, 8, 9, or 10 losing trades in a row. We cannot avoid that. This is the nature of trading the market. And this is why I attach much more importance in the way to control the risk per trade, just to survive without not an important negative impact on my trading account, to survive these losing streaks. And so another approach is to reduce the risk per trade after some losing trades. But this may be done in a very cautious way in order not to jeopardize the recovering process. And this is why we have to focus on trading systems having a large positive expectancy. And this is what makes trading complex. Defining some entry setups based, for example, on technicals only, or based on technicals and fundamentals. It's great. It's not so difficult after all. But if you completely neglect the trade risk aspect and the money management aspect, you can still fail miserably in your trading process. So the trade risk aspect and the money management are an essential part of any trading system. And then the third part of the trading system is, of course, the psychology of the trader. Many traders are facing fears when they are in a trade. Let me take an example. Here, let's come back to the USD. And you see the virtue of patience. Many traders, when they open a trade, for example, like here, and then they see that immediately after the price is going against them, begin to fear. And they are, or during that pullback, they were in a profit, and they begin to see their profit evaporating, or at least a portion of it. And so they adopt a panic mode, and many will be inclined to scratch the trade or to close the trade, hoping to keep a portion of their profit on that trade. This is not good practice, because you don't exploit the trend when the trend unfolds. And so the reason for the fear are multiple. First of all, not understanding why the price is moving in that specific direction. This may be a reason. So a lack of knowledge, a lack of experience. Another reason may be also, especially when they panic seeing their profit evaporating, because their risk for the trade is too large. I have seen in the past traders taking a 5%, a 10% risk per trade. This is way, way too large. Even 2% is too large. Okay, look here what we have. Because we are in difficult market conditions today, if the price comes back on this level, I will make an MX. Okay, I consider to make an MX here. So I close one unit here. And so marking my chart with the MTM would mark my chart that way. And here I would make an MX. Normally, I should wait for the price to make a pullback above this level and to have an exit setup. But because we are in challenging market conditions, let's make an MX here now. You will see the impact in terms of trade risk management. And so we name an exit an MX1, because this indicates that I close one unit, the first unit I have in my trade. And I take the opportunity to adjust further my ESL. and I will adjust my ESL. Let me see. First of all, my movement invalidation area comes here, and my ESL, I can adjust it, let's say here, in this area. Oops, in this area. Okay. Now let's make a risk evaluation of the trade. Yeah, Jan, there are several types of fear. Fear to open a trade when an opportunity happens. Fear to lose money during a trade. Fear to succeed also. This happens too. And so a great way to reduce that fear and to feel much more comfortable is simply to reduce the risk on the trade. And reducing the risk on the trade does not mean to reduce the size of the stop loss, but to reduce the percentage of the trading account we allocate to the trade. For example, instead of using 2%, use a 1%, use 0.5%. Now let's make a quick evaluation of this trade. This closed unit has made a profit of, you see here, 11.5 pips minus the spread 2.5, so 9 pips. 9 pips as a net profit. It is not a big profit because we are not in good market conditions for today, but still a small profit. Okay. And so what is the worst risk on this present trade? It's on the stop loss here. And the risk on the remaining open unit is only, you can see here, 3 pips plus the spread 2.5. So this means 5.5 pips. So my worst risk here is at minus 5.5 pips. Okay. In this area, I am guaranteed on the second unit to lose maximum 1 pip, around 1 pip. So my risk is minus 1. Okay, minus 1. Let's consider the worst risk scenario. So here, with these minus 5.5 pips. If I subtract these 5.5 pips from this plus 9 positive result, I'm left with 4 pips profit. So I am risk-free in this trade. And it is even better with the movement invalidation area here. Okay? But so this means that now I can stay freely in this trade, and I can close my second unit on 2 possibilities, either on the next exit setup or when the price will reach the movement invalidation. And if the price resumes the up movement or begin to range somewhat, you will see this movement invalidation continuing going upward, so improving the result of the second unit. Okay. Let's have a look on the Cardian. The Cardian is doing nothing for the moment, so nothing to consider, just patience. And for the other trade, you see the pound kiwi I have marked as a potential opportunity resumes the down movement. Here, the pound is making a pullback. The price is here around these levels. So as long as the price does not leave that area, the opportunities will not be so good. But then the price will face our home base channel, so not a nice opportunity to trade. And with the pound CAD, you see that the price is resuming the down movement. So not big movement, but movement going into the direction I have indicated. So what time is it? Because we are approaching the time to wrap up this session in around 15 minutes. And so very often a way to overcome the psychological problem of the trader is to reduce the risk per trade in such a way that a losing trade does not hurt not only the trader's account, but also the trader's ego. We have never to neglect the ego of the trader. I have myself a big ego. And sometimes it's our ego is our enemy. And so this is why we have to stay strictly disciplined in our trading process. Now, for traders having more serious psychological problems due to some traumatic past, of course, there is always the possibility to be helped by some psychological coach. This is a possibility to never neglect, of course. And there are some really good coach everywhere around the world. But as I'm used to say, most of the psychological problems are overcome when the trader has a better view of the risk he or she is taking on the trade, on each trade, and simply by reducing the risk per trade. In fact, we have several courses, 5 levels of the max courses: the max primer, the max light, the max standard, the max advanced, and the max SAM ETF, which are all our flagship courses. But we have also a series of what we call mini course. And a mini course stands for just one session on a specific subject. For example, we have a mini course on these specific max price levels. We have a mini course on how to handle trades when we are in a tight consolidation zone area, and so on and so on. And one of these mini courses is how each trader can define the appropriate risk level per trade in his or her own situation. And it is really a subtle way to determine the most appropriate risk level per trade for each person, depending on the risk averse of each person. And it may happen, for example, that the ideal risk per trade for one trader will be, for example, 3/4 of 1% per trade. And so I describe a very detailed process helping the traders to find his or her optimal risk per trade. You can see the other pair resumed their movement as expected. Now it seems that the price is moving outside the pound Aussie. So this would be a possible setup to go short on the pound Aussie here now, with an entry level, but the price is facing the home base, so it's a little too early to consider. Yeah, risky here. We may have soon an exit setup here in the pound, in the euro US dollar, and another one here. We have an exit, a short setup in the pound US dollar, and you see, boom, the price is going downward quickly now. So we have lots of entry setups, so a lot of opportunities, and you can see the quality of our setups even during challenging period. The price can still make movement provided we know how to handle the point. You have seen the typical example here, and the price was not in a choppy mode, but recognizing that the price was in a poor price action, then taking the fast profit I use with my discretionary choice on how to make the first MX. Now my trade, whatever may happen, is a risk-free trade, and progressively this small area, even with the price retracing, is going upward and upward and upward, and now my risk becomes always the same, -1 pips approximately. But should the price resume for somebody up movement, this level will move upward. And if this what will happen, even with my stop loss, I will be able to move my stop loss upward in such a way to be even risk-free with my second unit on that stop loss. Okay, any questions before we wrap up? Because we will wrap up in around 10 minutes now. So, I see a question by Randy. So on the US dollar yen, where do you look for second target? I don't fix a target, Randy, never. I don't fix a target. Even for my first MX, I don't necessarily take my first MX on a target profit. My minimum level is defined with a specific rule, of course, but usually what I do is I wait for the price to go above my first profit level, make a retracement in such a way to have an exit setup, and then I take my profit in that area. This is the most often situation which arise when we are in normal days. Today we are in a challenging day, so I prefer to make my trade safer and take my profit as soon as the price has achieved my minimum level. For the second units, I don't have a target profit because now I know that I am in a risk-free situation, and so I want to stay in the trade as long as possible. Okay? We have no other news today which can change the market, so we have two choices: either close the second unit on the next exit setup or wait for the price to reach the movement invalidation. And if the price moves upward a long time period, you will see this area moving upward, and so making your trade an even better trade. So it's up to each trader to define the strategy for the final exit. On the long term, they are similar, okay? But I don't fix a target. What I can see is on my chart, the next levels, which may be supply levels, are way, way higher, more than, where is my price? It is approximately here. So more than 150, 80 pips higher. I don't think the price will reach that level today, okay? For example, here we may have no, this is not an exit setup. The exit setup was on this candle here. So an exit can be made here. But the distance from this exit, or even here, to this exit is only 4 pips. So I would prefer to stay in the trade as much as possible and make my exit in this movement invalidation area, because there is still the possibility for that movement, for that area to move upward. So we have several ways to close the trade, but we never fix a target profit. Because fixing a target profit, okay, is a way to force the market. We are never sure how far the price will go. So if we are not sure how far the price will go, why should we fix the target profit? We take what the market gives us. When do you look to add more positions? Okay, that is, on the contrary, a good question. When we have a nice trending days on several pairs, because we have reasons for the market to move, and so when the price is making nice trends, and we see that by observing several pairs, in fact, we add to a trade whenever we have one of our entry setup. But we have to pay attention to the risk aspect. Let's suppose that here we have, it is not the case, but let's suppose, just for the sake of the explanation, we have another entry setup, okay? Because this candle is a valid entry setup. And so we can consider to add to our position. However, in terms of risk management, this setup may be risky. And so in order to control that risk, one of the criteria we want is the price must have moved enough from the previous entry. In this case, the price has moved only, how many pips? 9 pips. It's not enough. The price must have moved further. Okay? And so we have criteria in terms of how much the price must have moved before considering adding to the position. And we have to consider the quality of the setup also. In this case, it would certainly not be a quality setup. So, but it was just for the sake of the explanation. So we have rules telling us when to add to the position. We call that a scaling, and the rules, as for any other entry, takes into account the quality on the technical aspect, the quality on the risk aspect, and the global context. of course. When we are in a more challenging day, we have a tendency to make no scalings or few scalings. So in this case, in this example, we had no opportunity for the moment to consider a scaling. And I will even not make a scaling today. And now it's in the price is resuming the up movement. So we are still in the USD yen pair. We are still in the CAD yen pair. And you see the movement the pound CAD has made, the movement the pound Aussie is making, the movement of the pound Kiwi. Not big movement, but still good setups. Okay? I would like to thank all the attendees in this room, in this session, in a very warmly way. So thank you very much for your presence and for your participation. I hope you have appreciated what I have explained today. And so let's see on the other side for any of our Max course. And in the meantime, I wish you a great rest of the week and take care. Bye everyone.